This episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And joining us now to take a look at the market trade as we wrapped up the final full week of August. Hard to believe the calendar's getting ready to turn over to September. We are joined by our good friend Chad Hart with Iowa State University. And Chad, welcome back into Market Talk, sir. How are you?
It's my pleasure to be with you, Jesse.
Always enjoy our conversations, Chad, and great to catch up with you again. Let's look at the grain markets first. Pretty interesting week in grains across the board. Friday saw plenty of bullish momentum to the upside after watching crop tours all week, watching weather, watching the Fed symposium in Wyoming. Just a lot of things the market was paying attention to, but really solid strength across the board in grains on the day Friday. Talk about that a little bit.
Yeah, I think as we're looking at especially the Friday action here, it is this idea of that, what the crop tours are sort of showing is there are some problems out there, especially as we look at, let's call it around and towards the middle of the Corn Belt. And as the tours went on this week, what we noticed is definitely a separation between the southern crop versus the northern crop. And trying to sort of, I'd say, balance out, is there enough strength as we look at, say, Minnesota, northern Iowa, into northern Illinois to offset some of the losses that we were seeing in South Dakota, Nebraska, Kansas, Ohio. And, I think the market trade, especially here on Friday, was like, these numbers are going to come in below USDA's estimate. We are seeing some tighter supplies, and therefore putting some of that weather premium that we took out of the market in July, we're putting it back in today to reflect that possible shortness on the crop.
Well, Chad, breaking down commodities a little bit, corn, looking there, really the last couple of weeks has been kind of impressive in this corn market, how well it has held up. I think something like, roughly 20 days out of 26 days or so, we've gone up in the corn market, at least I think at Dees Corn, and really trading at some pretty solid levels around 650, 660. I mean, you look at this corn market on top of what we found with the tour. What else is supporting here? Because it really just feels like this corn market has slowly chugged higher the last month.
It really has. And I think, it goes back to why were we down sort of fairly significantly as we looked at last month? And it was the combination of, I think you saw a lot of folks take risk off in July. So we saw a lot of the premium that was built in because of the Ukrainian war and because of weather disappear in July. And now we're rebuilding some of that as we move through August. And every time we look at the weather reports, the drought monitor, as we look at these crop tours that are going on now, it just adds another layer of evidence that, this crop's probably not nearly as strong as we saw with last year, even though the general setup is still the same. Concerns about drought across the Midwest, impacting the crop production. But I think we're seeing some different effects this year as opposed to last year.
Well, as we look at the balance sheets and look at maybe some of these declining yield ideas, it seems hard to imagine we're going to get to that 175 mark that USDA put out in August on national corn yield. But Chad, there's not a lot of wiggle room in the 22-23 balance sheet here, and I would have to think that at some point price rationing is going to have to come into this corn market, especially if these lower yield ideas come to fruition.
I would agree with that, and I think the place to watch here is the export side. When we're looking here, I would say the 175 that USDA put out there, again, it was based on the farmer surveys from early August, and I think and I've been reading a lot of commentary on a lot of the tours going on right now, and a lot of folks say the crop looks better from the roadway than that does when we get into the field. And I think that's the same thing that impacted USDA's number of 175 there. A lot of that was, what's the view from the roadway as opposed to being deep in the field? And so as we bring that yield down, though, yeah, USDA's got to readjust the balance sheet to bring things back in balance. And like I say, I think exports is the feature to watch right there. Typically, when we do have a short crop here in the U.S., it is exports that move significantly to balance back out that sheet. And so that's why there has been a lot of concern about how are export sales holding up given these improving prices, as we talked about earlier.
Well, and you mentioned exports. I think China could possibly step in some more. I'd love your thoughts on that. I mean, historic drought in a lot of their production areas going on. Plus, you see drought in parts of Europe. We know the export issues out of Ukraine. Talk about what you think as far as exports with China being concerned here, because it feels like despite some of the tensions over Taiwan that may have eased, I think at some point China's really going to have to step back in here. We've seen that already this week on the soybean side a little bit too.
Yep, we have. And as you mentioned, the idea is we're not the only place facing significant weather extremes right now with droughts in China and Europe. And so, we know that there should be increased feed demand because of that. The challenge here, though, is I think the same thing as we look at the U.S., as we look at our domestic usage as well. We've seen our feed demand retreat because of, basically smaller herds driven by the drought here. There's concern that the same thing is happening as we're looking globally here. So while we see the need for more feed because of drought conditions, we also know that drought conditions are also limiting how much feed demand there could be out there. And I think that's the scary thing as traders are looking forward, is trying to figure out which of those two factors, both due to drought, are which one's larger as we're moving forward here. Will we see more demand because of the drought out there, or will we see less because they cut back on their livestock industries?
Well, and I think as well, we can rope the soy complex in here on that discussion too, with meal crush margins remaining the way they are, remaining strong. We saw meal really an upside leader on Friday, bean oil in tow. You think about the soy complex, roping that into the discussion as well as part of the feed grains. I mean, looking at soybeans as well, some of the spread action between soybeans and corn. What are your thoughts in this bean market? Is it maybe resuming a leadership role in the grains, or what are your thoughts there?
I think it is, and I think it goes back to, as you mentioned here, when we're looking at that concern about feed demand internationally, we tend to worry about it less with pork and poultry than we do with cattle. And I think that drives us more towards looking at the protein side of the feed ration, which means looking at soybean meal. And you're right, we have seen an increase in interest there. And, that's the one that is less impacted by drought as we're moving forward here. So I think we will see beans take on more of that leadership role that it's had, especially over the past 5 or 6 years. And that's a place to watch how China develops here, because their crush margins have been softer than ours. And so one of the things I'm contemplating or looking at here is, how does China balance out its own internal needs as we look at her? They tend to rely heavily on importing the beans and creating their own meal, but they may be seeing some price advantages to actually bringing in some meal as we look further down the line here.
Well, Chad, I think farmers, they should by now hopefully have a decent idea of what they have for this year's crop. And so, depending on where they're at with their marketing for this new crop, corn and beans, again, they should have a decent handle on it. But you mentioned, some of these export thoughts and some of the global issues we have out there. I know we're watching energy prices in Europe, fertilizer plant shutdowns, and thinking about 2023's crop. If some producers have maybe thought about some marketing already, you look at, December 23 corn around that 610, 615 mark, November 23 beans, kind of that 1380 mark. Is it realistic to try and maybe lock in a little bit of even the 23 crop, or is it too hard to judge right now with all of these global factors and wondering about input prices, et cetera, moving forward?
Well, I'd say seasonally now is not a time where we really like to make a lot of moves, because we tend to see our lowest prices of the year here right before harvest starts. But you bring up this idea of, as we're looking forward to 2023, there's this balancing act between Concerns about higher input cost, and let's face it, I think we will see higher input costs as we look towards 2023. Concerns about where energy prices are going to go. Yet we still have really good prices on the board as we look out there. You mentioned the 610 for DH23 corn. So the only moves I'm really looking to make right now would be maybe if I'm looking at trying to pre-purchase some fertilizer right now and I'm going to lock in that fertilizer price. Well, now's a good time. If I'm going to lock in that fertilizer price, let me lock in a little bit of corn with it as well, because what I'm doing there is I'm managing my margin. I know what I'm setting my output price at. I know what I'm setting my input cost at. And, if that's a good number today, then I'll protect that as we move forward.
Great thoughts there, Chad. Great thoughts. Let's talk the wheat market a little bit. This wheat market has kind of just been doing wheat things, I would say, the last couple of weeks. We know the story with Russia, Ukraine. We know we've taken a lot of this premium out. We're looking at a pretty good spring wheat crop in the Northern Plains and Canada. Russia's got a big wheat crop and finally getting some precipitation in the Southern Plains ahead of winter wheat harvest. So my question is, do you think we are setting ourselves up to, have supplies increase here of wheat around the world? And could that be a damper on prices moving forward?
Well, I think that is the damper as we're looking forward right now. I mean, if you look back to say 3-4 months ago and you look at the projections for global wheat production that USDA was putting out there, we were seeing a fairly good cut in overall global production of wheat. That has now popped back up to where actually this year's estimate for wheat production is actually higher than last year. Barely, but it is increasing. And so, as you mentioned, unlike or sort of in the reverse to what we're seeing with corn and beans, where we're seeing these global events pull production down, wheat, we're seeing it actually bounce back up as we're looking out there. And so the other big deal is, as you say, it's not just here in the U.S. where we're seeing increased production. We're seeing it in other places around the world, and especially within some of our export competitors. And so while we are seeing some additional interest also in wheat purchases here, a lot of that is going to our overseas competitors. So we're not seeing the gains that we might see in our price as you might expect, given more global trade in wheat.
Well, on the flip side of that, Chad, with high fertilizer prices, do you think that maybe limits some of the winter wheat planting potential here this fall in the Southern Plains and or next year's spring wheat crop, just because, it takes a decent amount of fertilizer on that wheat crop? Do you think that is an effect that maybe limits some acreage here in the U.S.?
I do agree that I think it will, because when it comes down to it, if I'm going to look to spend that much on fertilizer, I'm going to look for the higher revenue crop to cover it with. So I think that leans towards corn as we're going here versus wheat, even though, they both are high fertilizer demand crops. The idea is then you chase the higher revenues.
Fair enough. Let's talk South America a little bit. We're getting ready for, planting down there, Brazil, Argentina. Obviously, we've seen them add acreage upon acreage upon acreage here in recent years, and we know that they're one of our biggest competitors on the global scale now. What are your thoughts with how things are shaping up in South America as we look towards their new growing season coming up here? Anything stand out to you that we're kind of watching closely as we enter spring planting down there?
Well, I think what we're looking at down there is sort of like we looked at here. The idea is that, as you mentioned, we know they're going to add acres. It's more a matter of how well will they produce on those acres they're willing to add. And it comes right back down to, as we look at the weather patterns globally, La Niñas tended to dominate that. We're basically in our third year in a row of that, with the forecast possibly of going into a fourth. And we know that creates some significant weather challenges to the South American crop. But I think, how to put this, we've never had 4 years in a row of La Nina back to back to back to back. So I think for most folks, the betting odds say, nope, they're going to try to plant, and that will return to more neutral conditions, which should mean more production coming out of South America in the next year to year and a half. And so I think we will see increased competition from South America because of not only the addition of the acres, but let's call it a return to more normal weather patterns.
Well, and someone posed this thought on social media earlier this morning on Twitter. I thought it was interesting, and this is hypothetical speak, but what would happen to price action if, say, South America has a huge crop this upcoming growing season, and we realize our potential here in the U.S. as well with record crops. If you have record crops with record crops on both the northern hemisphere and the southern hemisphere together, I feel like that would be a big weight on commodity prices, Chad.
It would, and I can argue we've been through that scenario. So you think back about a decade ago, coming out of the drought of 2011, 2012, going into 2013, 2014, 2015, we saw very similar impacts there. Sort of global drought conditions hampering 11 and 12 to incredibly large to record crops 2013 and 14, and what it meant was a significant slide in prices where we went from up here in the $7-8 range. We were there back in 2012, and we slid back down into the 3s and 4s within about 18 months. So if we do get that surge in production, that could be possible, and a lot of that would have to, let's face it, hinge upon the weather conditions we have. It does mean the potential for large downward movement in prices over time.
Chad, let's talk livestock as well. This cattle market really just feels like it's been chugging along since the last time we talked. Any thoughts you're seeing in cattle here as we look to wrap up the month of August?
Well, that's the deal. I think as we look at the cow market, right, it does just kind of chug on along. And we have seen supplies continue to sort of, I guess I'll call it tighten. We know that the herd's not getting any larger, but demand remains robust. And especially in this case, I'll point to international demand again. That has been the one sector, when I look at agriculture, the beef sector, where we continue to see record exports heading out of the U.S. to the rest of the world. And so you put those two features together, and it means at least, let's call it strong, stable prices, if not rising prices, as we're looking forward.
Hog market, that cash index at October now have a pretty big spread between them as we saw August go off the board here a few weeks back. What are your thoughts on the hog market? I know we've had a big pullback for the most part on this week before we found some support end of the week. What are your thoughts on hogs right now?
We have, and I'd say this is where I'm seeing let's call it the flip side of the coin is we got with beef here. The biggest challenge I see with the pork industry right now is that while domestic demand remains pretty good, it's the international demand that is still well off of what it's been over the past couple of years. We're down about 20% in terms of those export sales as we look out there, and that just means there's more pork sort of overhanging the market and preventing that price from really coming up as it is. That said, though, I'm going to say historically, as we look at fourth quarter pricing for pork right now, compared to history, these are still very good prices. It's just that it's not as robust as what we've seen on like the crop side or even in the cattle market.
Well, Chad, on top of the livestock markets, of course, we think about inflation and its weight on the markets in general. We know it definitely impacts what's going on at the retail counter as well for meat, et cetera. But just talking inflation as a whole, Fed Chair Powell spoke Friday morning in Wyoming, kind of wrapping up this symposium here this past week. Pretty short comments. I'm wondering your thoughts with what you heard from Fed Chair Powell. Did we really get anything new from him to wrap up the week?
I would argue not really, but at the same time too, I'm not sure what else he could provide us at this point in time. The biggest challenge that the Fed has faced is trying to, if you will, separate out what we would argue are the transitory effects of all the problems due to COVID and supply chain issues around the world versus what has been the more, let's call it, traditional sources of inflation as we move forward, and how to disentangle those and then, if you will, allow the supply chains to figure themselves out. Try not to interfere with that while at the same time holding down those traditional factors that tend to lead to inflation. The Fed's biggest tool here is the interest rate, moves that they made. They've made a couple of fairly strong moves to try to hold off those more, let's call it, permanent pressures to inflation. At the same time, too, they're afraid of pushing too hard on that and really putting the damper on the economy. And so, I think Chairman Powell is trying to do his best to sort of walk this, tightrope walk here right now, trying to ease those inflationary pressures without damaging the economy.
Well, and trying to manage that soft landing. We'll see if they can do it or not. Chad, great stuff. Before we run out of time today, any final thoughts, anything else you want to reiterate for us on the show?
Well, like I say, as I'm looking forward here right now, I'm going to say, the biggest thing here will be figuring out that yield as we move forward. What the crop tours did for us is they do show where the problem spots are right now. And as we move towards September, USDA will start to do their objective yield survey. So we'll really start to firm in on those supplies looking forward. And then on the demand side, like I say, I'm going to focus on exports here over the next couple of months, because I think that's where, if you will, the biggest adjustments have to be made in determining how to rebalance the balance sheets as we look forward this fall.
Well, always a pleasure, sir. Appreciate the time and insight. Chad Hart with Iowa State University. Thanks again, and we'll talk to you again real soon.
Thank you, sir.
Chad Hart with Iowa State University. That's going to do it for Market Talk today. Find us, markettalkag.com. I'm Jesse Allen. Have a great afternoon.